While the averages didn't move all that much here today, we actually did see some interesting movements within the market once we open up the hood and do a little bit further digging. So we're going to take a look at value versus growth a little bit in today's session. We're also going to take a peek at our current posture, where we do have the Russell 2000 giving us a bullish intermediate confirmation signal. And then we're going to get into our trade application example, where I wanted to focus on a beaten up tech stock that might be primed for a sold put opportunity to purchase it at a lower price, and thus a very interesting dividend yield. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 16th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe, go down to our description area, and sign up for our email distribution list if you haven't done so already. In addition to that, we're heavy users of Twitter. I would encourage you to follow me. My handle is @BrandonVanZee, and we really appreciate those of you that click like and retweet. And then last but not least, also have a presence over there on Facebook. Feel free to join our group at that web address you see in front of you. All right, let's go ahead and dive into today's activity. And as you can see, I've got chart 4B pulled up here in front of us. And we did close just a hair lower on the S&P 500 today. We were down 0.06%. As I mentioned before, we actually had a little bit more movement than what might be catching your eye, at least initially. There's always interesting developments, of course, in the markets. We do, of course, have our earnings season rolling on. We also saw tonight a lot of the 13F filings with the SEC came out for all the big hedge fund and money managers out there. Some of you saw me tweeting about Warren Buffett's recent additions of Chevron and Verizon, in addition to selling off some stakes in other companies. So feel free to check out my Twitter feed for additional information there. So we always have corporate news that's kind of capturing our attention. And of course today, the big news story, at least here in the United States, was the weather. Rarely does the weather kind of capture the attention of our entire country because we are such a large country that's spread out over thousands of miles. But right now we are in an absolute cold streak here that stretches all the way down to even Texas, where we've got folks that are still without power down in Texas because of ice and snow and other things. So anyway, that did have a little bit of an impact on the markets here today. One of the better performing sectors was energy, and we do see crude oil prices continuing to go up as they had to shut down some of their refining capacity down there in Texas, Louisiana, and the like. So we'll get to that conversation here in a little bit, but just wanted to kind of emphasize that while the end result of the market seemed like it was a ho-hum day, there was actually some interesting developments kind of underneath the hood here. So let's take a peek at where things stand with our posture from the four major markets perspective. Remember, for those of you that are newer, the background colors of the chart will tell us what our posture is. And at this moment in time, you can see that our posture remains strongly bullish on all four of our charts, with that background color being that dark green color. That signifies that this green line on the market forecast technical indicator that you can find on the Thinkorswim platform, it's in the upper reversal zone right now in all four of our charts. Remember, you could also get a strongly bullish posture by having the green line rising between 50 and 80, but right now all of them are in the upper reversal zone, and that's not a big surprise. Many of you are aware that we've been on an extremely long kind of intermediate term trend. Technically, we fell out of that for a day or two here, at the end of January. But I think a lot of people kind of look at this as one major move that's been taking place here over the last several months. And obviously, it's been quite extended. So we are overdue for some sort of a give back of sorts. Whether that happens here in the short term or not is anybody's guess. But of course, the longer we keep pushing to new highs, as we have here in recent months, the greater the chance is that we're closer to the end of that than the beginning. So in other words, brace yourself. It doesn't mean that we can't continue to kind of grind higher. It's just that you might want to take a little bit less risk than you normally would, maybe smaller position sizes, or perhaps focusing on blue chip stocks as opposed to the more speculative companies out there. Anyway, as it stands right now, we do have strongly bullish postures across the board. Our only index to close higher here today was the Dow Jones Industrial Average. You'll notice that we have this little high label here. Since it was an update, it was also a new closing high in addition to the intraday high. We did touch intraday highs on the S&P 500 and the NASDAQ Composite as well. It's just that we closed lower on the day and therefore can't make the claim of closing highs. And as I mentioned in the intro, something noteworthy is taking place right now on the Russell 2000 Small Cap Index. You'll notice here that the green line is considered strongly bullish as it's up here in the upper reversal zone, on the same day that we have the red line or the momentum line in the lower reversal zone, and that constitutes a bullish intermediate confirmation signal. It's kind of a buy the dips mentality where you basically can claim that you have a strongly bullish posture combined with a short-term pullback, right? That's what that more sensitive red line is telling us. And of course, the Russell 2000 was down today. It was down about 0.72%. Not a massive give back, but at least a little bit there off the high that it set about 4 days ago here. We do have the blue line between 50 and 20 as well, giving us a little bit more of an ideal setup there than if the blue line was positioned elsewhere on the chart. So there's a healthy enough give back there where it might be worth investigating kind of the buy the dip mentality here. But again, keep that in the context of we are well within multi-month bull market at this point, and so you shouldn't expect the world out of any sort of a move from this level, but at least we have a trade signal that is set up that's worth passing along to you. Let's go ahead and now take a look at our 3 green arrows chart, and this will be chart 4D. That'll come up for me. There we go. Now remember, the background color of this particular chart is a little bit different than the last one. This one will tell us whether we have 3 green arrows or not. 3 green arrows is just a way to say that we're looking at 3 different technical indicators: the 30-day moving average, the MACD histogram, and the stochastic, and we're trying to determine if they are currently considered bullish or bearish or otherwise. And so when we have 3 green arrows, we have the background color turn green, as we do in all 4 of our charts cases right now, telling us that this is we're in a bullish trend at this moment in time. And it's sometimes it's hard to determine that. Other times it's less hard. And right now, I would say it's probably pretty obvious that we're in a strongly bullish market that would be more conducive to trend trading. In fact, good news to share on that front, those of you that are premium members that have access to our Telegram trade alerts, and also those of you that follow me on Twitter might have noticed me talking about our 7th coffee can stock that we've added in my top-down trend trading class. Coffee can stock is effectively a stock that we started off trend trading with the thoughts of rotating it in and out depending upon strength, but they ended up doing so well that they doubled for us, in which case we sell half of our shares and then play with the house's money on the other half, holding them indefinitely. And we've had the good fortune of having that happen to us 7 times within the last year. And so Synapsys was the latest winner from that perspective here today. Kind of a quiet technology company, but one that did hit a double there for us. So congrats to those of you that are part of that Monday top-down trend trading class. That also means that we don't need to sell a stock this upcoming Monday. We'll have cash available to us from that half sale that we made on Synapsys, and we'll look forward to putting that money to work in our class on Monday. I remember yesterday we didn't have class because it was President's Day, so the markets weren't open. So I'll look forward to seeing where things stand with y'all on Monday. Anyway, point is, this is a good trend trading environment. No surprise there, right? This has been one of the greatest trend trading environments I've ever seen in all of my years of trading. And so it's been fun to be a part of. It's been fun to see the accounts always hitting those new all-time highs. When it ends is anybody's guess. What we do know is that we trade what we see. And right now, what we see are higher highs and higher lows. And eventually that will change. But when it does, we'll start seeing the changes right in front of us, right? Broken support levels and different things like that. And right now, we just can't make that claim. All right, let's go ahead and take a look at our longer term view now. This will be our 1040 crossover method, chart 4C, for those of you that are premium market scholars following along at home. And this particular chart is a longer term chart. This is 3 years in length for each one of these, and every one of the candles you see is 1 week in length. And so gives us kind of a slightly different vantage point than the other charts I shared with you a moment ago. In this case, what we're looking for are crossovers of the moving averages themselves. The orange lines represent the 10-week moving averages. The blue lines represent the 40-week moving averages. As I mentioned regularly, this particular trade signal does not, provide a whole lot of excitement or action. It is something that is pretty mundane because trade signals do not occur all that regularly. You can see that the last time we had any sort of a change was on the Russell 2000. That was back in August, where we went from a bearish crossover to a bullish crossover there, right, where the chart went from pink to green, and we've stayed bullish that entire time. In fact, a tremendous run, one of the greatest runs you'll ever see out of the small caps right there. And so we're still in those bullish positions for the longer term perspective. For those of you that might be, maintaining mutual fund positions in broad indices in your maybe your 401ks or other money that you can't really actively trade. This is a good way to kind of just stick with the trend whenever possible, and it's clearly been a nice beneficiary of this bull market we've seen over the last several months. All right, let's go ahead and take a quick little stop on over here to the internet. I always like to get an opportunity to say thank you to those of you that help support us on social media. In particular, we pay the most attention to Twitter, and I'm always shooting for triple-digit likes, and you guys, once again, did not let me down. 119 of you came out of the woodwork to take the 5 seconds to click like, and again, that only serves your benefit in addition to ours. In other words, as long as we continue to have support from the community, we'll continue to do these videos as often as possible. And so we appreciate those of you that go out of your way to do that. Remember, there's 4 different ways to click like. On Twitter, you can either do it right here on our website in this little widget area here by just clicking this little heart. You can also go directly to our Twitter feed. So for instance, if we come over here to my Twitter feed right now, you can see that this is pinned to the top of my timeline. So if you just went to twitter.com/Brandon Van Z, that'll get you there. Also, you'll see everything else that I've been tweeting about during the day, including some of this Berkshire Hathaway information that I'd mentioned to you before. So that's the second way you could find the tweet. You can also find it in the email that we send you guys that notifies you of the release of the market forecast, or I should say the market outlook video that includes the market forecast technical indicator. And then you can also find it in the YouTube description area directly below our video for those of you that watch the video directly on YouTube. So thank you very much to the 119 of you that did that last time around. It means a lot. And so, whoever is doing it out there, whether it's Dividend Company or Filing Search or Judy or John or Deborah, Gerald, Brad, Fun, Jonesy, Glenn or Irene or Kay or Valerie, Claire. There's tons and tons of you that obviously help support us, and we do recognize it, and we see the notifications coming in each time you do that. And so thank you. Big tip of the hat to you. It means a lot to us. Also, while we're over here, thought I would show you guys the sector selector. This is something that gets updated officially on Friday nights after the close. So even though we didn't have class for my top-down trend trading class yesterday due to the holiday, this is still updated information as of Friday's close. You can see here the date says February 12th. And what we learned on Friday is that communications were rallying pretty strongly last week, and so they were able to go all the way up to the number 1 slot. And it's been a long time since they were number 1. You can see this is a rolling 3-month graphic here, and this orange line has never been up there at that top slot in the 3-month period. There have been times in the past where that has been the case, but not in the last 3 months. And so it did knock down the discretionary stocks by 1 level there. We did see energy fall a touch there as well. Now again, keep in mind this is not including today's information. It is possible that with the pop in energy stocks, we might have seen the energy rankings go up to maybe number 2 or number 1. But I'll update that again this upcoming Friday, and we'll see if there's any major changes in this holiday shortened week. On the downside, no surprise to see utilities dead last, and they were one of our worst performers here today as well. One of the big storylines today was what was going on with interest rates, and interest rates are now at their highest level since last March, and many of you are aware that interest rates moving up rapidly generally help the financials, but can hurt the utilities and real estate areas there. Anyway, let's go ahead and take a look at some 12 grid analysis now. And you can see here, I'm going to pull up chart 5A first. This will be our asset class 12 grid. And here's what I'm referencing down in the lower right-hand corner here. Take a look at TNX just shooting up like you wouldn't believe. Now, those of you that have been watching this presentation for the last several months know that I probably sound like a broken record because I've mentioned multiple times along the way how beautiful the chart of the 10-year U.S. Treasury yield has been. I said if you just take TNX out of there and replace it with the ticker symbol of your favorite growth stock, that you'd be salivating over this chart. And it continues to look absolutely phenomenal. You can see that it's really respecting the 30-day moving average, which is that moving average we use on the chart here. You can see most of the time it comes down to this moving average, bounces off of it. Comes down to the moving average, bounces off of it. Moving average bounces off, moving average bounces off, moving average bounces off, moving average bounces off. Point is, it's not spending time below its moving average, which basically is feeding upon itself, right? The moving average itself is just a recognition of the average prices in the last 30 sessions. And if the average prices continue to go higher, the average itself will continue to go higher. And if price is never dropping below the average, it basically means you are in a sustained uptrend. So we have had some really robust bullishness out of Treasury yields. And remember, that's the opposite of what bond prices themselves are doing. If we look at this chart now in the middle rung off to the left, you can see that Treasuries have just been collapsing here. We didn't really get much. I talked about the possibility of a reversion to the mean quick little pop. I qualified that saying I was not expecting any sort of a trend change, and most of you know that we have a bearish trade on TLT going right now for this presentation with one of my previous trade applications. So I, for one, want to see TLT continuing to drop here. But I also recognize, hey, we got to a point where we had some oversold cluster signals here where we can maybe get a little bit of a reversion to the mean move. Well, we did get 3 up days in a row right there. They just didn't really amount to much. I called it a whimper when I was with you last week. And wow, look at how quickly that unwound. We're now way lower at this current level than we were right over here on February 5th. So clearly we continue to carve out lower highs and lower lows on U.S. government bonds. Now, the foreign bonds, in a strange way, have been almost more noteworthy to me. The reason I say that is there was a time when I was pointing out here, kind of in the November time period, November to early December time period, where foreign bonds actually looked pretty strong, especially in comparison to the way that U.S. government bonds were looking. And it's almost like the foreign bonds didn't get the message that bonds were supposed to be weak in this rising interest rate environment. And then as soon as the calendar flipped right here, this dotted kind of gray line, I know it's hard for you to see, but it's about right there. That's the year crossover from December into January. And it's almost like a light switch where we went from having this green moving average to mostly having a red moving average, telling us that price is now below a falling moving average, and it's trying to play catch up in a hurry here. This was a pretty steady drop that we've seen here in the last 3 days, and now we do have oversold cluster signals on both foreign bonds and also long-term U.S. Treasuries. Now, another educational tidbit that I've been trying to share with you over the months, and this stretches back even further than that for those of you that are in my premium classes, but just catch everybody up to speed in case this is your first YouTube video that you happen to stumble across with us here. One thing that might be worth pointing out is that high yield bonds are holding up great for a couple of reasons. I've mentioned before that right now, high yield bonds are highly correlated to oil prices. High yield bonds are another way to say junk bonds, and most of you are aware that if you're a company junky enough to raise high yield debt, that it's probably because the market doesn't really like your business prospects. And right now we're in an era where the companies that have stumbled the most, especially prior to the coronavirus, were oil and gas related companies. They were issuing a lot of high interest rate debt out there, not because they wanted to, but because they couldn't really turn it to anywhere else, right? They kind of were forced to do it in order to stay in business. So when we've had this massive rally back in oil prices like we've seen, this is an unbelievable chart right here. Take a look at oil. It's up 40% in 3 months. That has really helped support high yield bonds. These charts to the left, these other bond markets look absolutely atrocious. Up here, we actually have a pretty strong bullish trend going for high yield bonds. So again, just like in the stock market, where you can kind of distinguish good from bad when you're looking at trade setups, the same thing can be said for the bond market. It's not always quite as obvious, but right now is case in point that one certain corner of the bond market looks pretty healthy, and that's your high yield junk bonds. Other areas of the bond market that are being more directly impacted by rising rates do not look nearly as strong. You can see that gold had a pretty poor day as well. It's been fascinating to watch the difference between gold and oil, and that can happen. It doesn't happen all that regularly, but it's not completely unheard of at the same time. Obviously, they serve different functions. Oil markets right now, as I mentioned earlier, are rising partially because of the supply limitations, as a lot of refineries here in the United States were kind of shuttered over the weekend with the cold weather. There's obviously a lot of other potential disruptions across the globe that can affect oil prices as well. But it's been consistent. It's been a consistent winner for 3 months at this point, whereas gold has just sloshed around sideways. And right now it's got more of a bearish tilt towards it. You can see where we stand today on gold is not at the new lows of the last 3 months, but it's down there very close to those lows. So it is something we want to keep our eyes on there. It seems like the alternative currency money has clearly been shifting in one direction, and it has not been to the hard commodity of gold. Instead, it has been switching to Bitcoin. This chart off to the right-hand side in the middle rung here. Bitcoin hit $50,000 for the very first time in its history today. It has been an absolute rocket ship. We closed at about 49,000 at this moment in time, but it's been a bullish theme pretty much all year long. Some of you will recall that I took the bullish swing trade on Ethereum, one of the competitors to Bitcoin. But whether you're looking at those or Dogecoin's been getting a lot of press on social media, a lot of the alt coins out there are doing quite well at this moment in time. But the king of them all is still Bitcoin. And as long as it continues to hit new highs, the trend continues to shape up nicely. So at this moment in time, this has been one of the biggest home runs within the financial markets here in recent months. We also see up here some pretty decent strength out of foreign stocks here today in comparison to U.S. stocks. EFA was up 0.72 and did touch a new multi-month high, as did EEM. It was up 0.24%. And compare that then to the U.S. markets, which were effectively down here today. Not by much, but nonetheless, a little bit of underperformance there. You can also see that preferred stocks kind of rolling over here in a way as well, and that might be part of that interest rate sensitivity that I had mentioned before. Speaking of which, let's go ahead and talk about sectors now, because the interest rate conversation definitely bleeds over to the sector world. You can see that on the bottom rung here, we've got utilities and real estate. Those are your two most interest rate sensitive areas, negatively interest rate sensitive. So when interest rates go up, utilities and REITs tend to struggle. They're heavy borrowers of debt, so that would basically mean that their interest payments would be going up in the future. And there's always the comparison as well. Bonds oftentimes get compared to utility stocks, and if bond yields are going up, they might become more valuable than utility stocks, and utility stocks get sold off. So, there's a lot more that goes into it, but those are a couple of things you can kind of remind yourself in the back of your mind when you're trying to think of interest rate sensitivity. And so you can see that relationship did hold true here today, with utilities and REITs being the only two sectors that were down more than 1% as interest rates surged. The 10-year Treasury is now at 1.3%, the highest level since March. On the flip side of that, financials were one of our best sectors today. Financials did quite well. They were up 1.7%. You can see we touched a new high on financials, breaking out over that prior resistance area from January 14th. And if you're looking at some of those big banks, your Wells Fargos and your JP Morgans of the world, they're shaping up nicely. They're starting to trend pretty good. So don't count them out. I know it's been tough to trust them over the years because they've kind of been sitting out the rally in the last 3-4 years. But they've got some giddy up and go right now. And so we want to trust that the market participants know what they're doing, and they're going up for the right reasons. The other big winner from the sector perspective today was energy. You can see energy was up 2.5% today based on rising oil prices. And we did hear that news after the bell tonight about Chevron being added for a pretty sizable stake. I think it was like $4 billion over at Berkshire Hathaway. So I would imagine that Chevron will probably be up tomorrow in the pre-market session. It is trading a little bit higher after hours here tonight on that news. Let's go ahead and take a look at our ratio charts here as well. This is chart 5Q for those of you that are following along at home. Just wanted to point out a couple of these that stood out to me. First of all, in the lower left-hand corner, this kind of greenish area, it says growth stocks to value stocks. So when prices are going down, it means that growth stocks are underperforming value stocks. So there's a couple different ways you could look at that. This is a 3-month chart you're looking at down here. So over the last 3 months, growth stocks are still outperforming value stocks during that time period. But there is a little bit of a difference here since the beginning of February. Notice that the value stocks have started to really outperform, and that makes sense given what we know, with today's activity in particular. Those of you that follow my factor-based swing trading class on Wednesday mornings will know that the concept I've taught you guys for more than a year at this point is that the makeup of a lot of the value ETFs at this moment in time happen to be banks and oil companies. And value was out of favor for a long time in 2020, but they've found their moment to shine, right? Banks breaking out because of interest rates, and oil stocks breaking out because oil prices continue to go up on supply disruptions and other things. And so this is a moment where value stocks are kind of finding a little bit of traction here versus growth stocks. And we did see that play out today. A lot of those story stocks, your Pelotons and those types of companies really did struggle today. Meanwhile, the boring old banks like JP Morgan having nice rallies. The other thing I thought I would point out while we're over here is take a look at some of the extreme readings in stocks versus commodities. First of all, notice that we have basically a straight down line where stocks were in the upper left here and going to the lower right. Well, what that is telling us is that commodities are way outperforming stocks in the last 3 months. I saw David was tweeting about that to a degree today as well. But hopefully you guys are recognizing commodities are shining right now. Maybe not gold, but we do see a lot of the agricultural commodities and also the energy-related commodities firing in all cylinders right now. You can also see we have an extreme reading here with stocks versus bonds. Stocks are clearly outperforming bonds at this moment in time. We also see commodities destroying bonds, and that makes sense given what I just said here. If commodities are easily beating stocks and stocks are easily beating bonds, then clearly commodities must be destroying bonds, and that's exactly what's happening right here. So this could very well be setting up as more of a inflationary environment, as I had mentioned in my dividend growth investing class today when we talked about the industrial sector. For those of you that want to check that recording out, it is posted to our calendar. All right, let's go ahead and get into our trade application example now. It's a pretty basic idea here today. I just want to pull up chart 2A. This is our dividend stair-step chart. And I'm going to pull up ticker symbol CSCO. This is Cisco Systems. and had mentioned before that technology from a sector perspective was still pretty strong in the top 4 there of the sector selector. But there are some areas within technology that aren't going up at quite the same pace. And Cisco happens to be one of those. They're kind of old line tech, right? They're not the new up and coming cloud plays that are out there or anything like that. So this is a company that has kind of been in and out of the blue zone here on the dividend stair step chart. And just to catch everybody up to speed there, the blue zone is effectively the kind of the undervalued zone if you're judging a company's long-term value by its dividend yield. It's basically using a historical dividend yield and then plotting it as price going forward. And each company has its own unique dividend stair-step lines. And so at this moment in time, Cisco is generally a favorable investment if you can pick it up when it has a yield of 3.39% or higher. Right now, with the stock trading above the blue line, it's telling us that it's not overly attractive right here with a 3.18% yield. But if it were to drop down to the blue line or less, we might very well be interested. And so I did a sold put trade opportunity here today where I sold I think it was the April $41 put, and I was able to get around 1% return on risk for selling that. And so we would be committing to purchasing it down here at $41, which is clearly in the blue zone at this moment in time. And so it would have to fall a little ways to get there. And if it doesn't, then we get to keep that premium that we took in when we sold the put to begin with here today. So again, I always get the trades done while the market is open. So if you need the trade details and you're a premium member of Market Scholars, you'll see that information in our Telegram trade alert there. But it's a pretty basic idea, just that, hey, this is a company that is a big bellwether blue chip type of a company. I think it's got plenty of capacity to continue to raise dividends into the future. It's just that right now, I'm not overly enthusiastic about it at this level. However, if it were to fall down below the blue line, I think that's a much more attractive entry point for the long term. And so establishing a position at 41 through a sold put would be something I would highly entertain. Okay, so that's what I had for you here tonight. I hope you got some value out of checking out this presentation. If you did, the one thing that I request out of you is just simply click like for us there on Twitter. That'll go a long way for helping encourage us to do these videos as often as possible. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.